Excellent. Okay. So what I'd like to do, the the title of today's webinar is matching your technicals and fundamentals. So what I'd like to spend, hello Dave, what I'd like to do is spend a little bit of time sort of talking about oh David, we have a Cardinals Giants situation that has to be resolved. I'd like to talk a little bit about some critical thinking here as far as where we are fundamentally, how to time things, the sort of time horizons one looks at. And then I also want to talk about, how to time those with your technicals, given, that is obviously what the webinar is about today. All right. So there's a couple of things as a rule of thumb to remember. And they're as follows. When the market is extremely, and as always, I encourage as many questions as possible. So chime in with anything. I don't care what the subject is. I can work it into anything. All right. So there's a few rules here. Number one, when the market is violently volatile, I'm talking 200, 250 pips a day on the euro. Been a long, long time since you've seen that. Or 250 pips a day on the pound. The yens are moving a couple hundred pips, etc. plus. Then I'll argue that fundamentally you can trade, I don't want to say without fundamentals in mind, but you can just trade technically in front of you. There's enough volatility to make money in both directions, irrespective of the prevailing fundamentals. In a market like we've seen over the last 2 to 3 years, I think you're doing yourself a massive disservice if you're not trading at least along with the fundamentals, because the prevailing trends in the market are, for the most part, fundamental, and frankly, the central bankers of the world have told you which way to trade. They've literally stood up at their conferences and said, this is the way you should trade. Mario Draghi, 3 months ago, sits at his little desk there and with a smug little smile on his face and says the Eurozone will be in a, I forget the language he used, but basically he said, we will be on a divergent path to the Fed. In fact, I think he used those words. All right? He sat there and told you short the euro, literally. Okay? And now the Fed here in the United States, they play a little more of a political game, and you're going to read between the lines a little bit more. It's enough to drive one crazy, but that's just the way it is. All right. So number one rule is, if and when you can, trade with the prevailing fundamentals. If you don't know what the fundamentals are, or if they don't seem particularly clear, then maybe that's not your pair to trade. Okay, number two. As a rule of thumb, it's best to hold things with your fundamental bias, and then if you want to trade against it, keep the trade short. Okay, there's nothing worse than sitting and you getting trapped in the losing side of a trade when it's against your fundamental bias. All right, because then it's very difficult to manage one's emotions. It's very difficult to manage one's risk, and you know that you are not in the trade that you want to be in. All right, and then inevitably one gets absorbed by that and nothing else. It's a little bit like growing a mustache, right? You cannot do anything while being under the influence of Nigel Mansell. It cannot be done. All right, so a small joke there, but all right. So those are sort of the two main. Okay, number three is fundamentals in the market take months and months and months to work out. All right, months, guys. So I was wrong on the euro for 8 months. I was getting short at 137. Thank you, Ronnie. Like 137, 138, 136 on the way up, and then having to sit there while it worked itself out. So fundamentally, you can be early for months and months and months. All right. And I just think you just got to think of the market as an aircraft carrier trying to turn around in a harbor. You got to be careful that you're not going to bump into things, and it takes a lot to turn that puppy around. Right. So the pound is one of those. Yeah, the euro worked out well. The regret I have on the euro is the lack of bounce, if anything. Pan on file, I'll address that here in a minute because you bring up a good point. If anything, the euro, it did very well on the euro from 140 to like 131. But then this last 400 pips has been basically straight down, and it hasn't hit the sweet spot as far as loading up again. So, I've been trading other things. But don't worry, there's 27.5, there'll be shorts, and hopefully it gets up somewhere around 129.5, and at that point I think it's a very good short all the way back down to the 24s and 23s. Okay, so let's talk about the question. When trends are difficult to join, example, the pound to go up to dollar strength right now. Okay, so fundamentally, so the question really is, fundamentally, is the pound stronger than the dollar? I think the pound has been largely a victim of the dollar strength. Is the British economy stronger than the US economy? I would say that it's probably, the numbers that we're getting are fairly similar, kind of a slow, gradual stagflation going on. Will it recover earlier than the euro? Yes, I believe so. But this is one of those cases where the technicals sort of override things, and I'll show you what I mean. Here is a euro pound chart. And we'll just zoom out a little bit and check this out. Okay, now admittedly, it's taken months to get here, but the euro pound has effectively been in this sort of congestion area here for a very long time. Okay, and while we had prevailing dollar strength, it was tough for me to see the pound breaking out on its own mission while the euro pound was in this rangy area. The Fed will raise rates before the Bank of England, absolutely. I'm going to talk about that here. I'm going to talk about that here in a minute too, John, because I'm not so convinced on this whole Fed let's hike rates until we blue in the face thing. Now, yes, we may. I don't want to I don't want to cross-pollinate questions here. Let me finish up with this one, and we'll switch over to that because you bring up a good point. All right. So, in this case, as far as the pound fundamentals, I do think now. This is what I find. This is what I think. I think that Europe and the pound, just from a correlation standpoint, are going to recover quicker than anybody expects. All right, so it took a long time to get dollar strength. If you remember, people were expecting dollar strength for forever, and we eventually got now 6 months of it. But I think that the euro is going to surprise a lot of people. Bees are doing okay, thanks, Martin. Yeah. I think it's going to surprise a lot of people as to how quickly Europe recovers. All right? And remember, recoveries are relative to themselves. This is what's important. Okay, recoveries are not necessarily relative to where they were at their highest. They recoveries relative to themselves. Okay, so we're seeing some positive stuff out of Spain economically. Yeah, we are. And it's relative to the fact that Spain was in the toilet. So now it's looking a little bit better only because it's relative to itself, right? Even though the numbers are still poor themselves. And this is why we're seeing a lot of weakness out of Asia. China's still growing at 6%, but relative to where it was, it's in a slowing down phase. And that's what's important fundamentally. All right. So as far as, why has the pound dropped and hasn't gone up? Well, I think it's largely because of the correlation between the euro pound. And then you have the dollar component, and the pound has kind of fallen as a result of that. So, what I've been watching is something like this for the euro pound. I think euro pound's heading back to sort of this 80.50 mark, 80.80. And then it's going to try and, push down to 76, 77. So for my money, the pound is going to be weak despite being in, monthly support until we've gone up this couple hundred pips on the euro pound. And that's only because of the support here. So yes, fundamentally, I think that the pound is stronger than the euro, but weaker than the dollar. But in the context of this technical environment, the euro is probably going to be stronger than the pound for a week or two. Okay. So, getting long the pound sustainably is going to be fairly difficult just on the short term. Here's our pound, and if you draw out your, it's a little bit tough technically because you're coming off resistance, but you're also in the support zone. So what's likely? What's the likely scenario here? In my mind, you're going to get something like this. It's one of these things where really fundamentally it's not really in play yet. To me, you're going to get something like this going on. You're going to get pounds stuck between sort of 63 and 58. And in the meantime, you'd like to get euro sort of doing this, retracing back towards 130. And in the meantime, pound's going to sort of oscillate around in the 62 to 58 zone. And that's largely, not necessarily fundamentally, that's largely the case because of where we are technically. Okay? And then you'd like to sort of see something like this develop on the euro and the pound, something more like that, sort of a fake break and back to 65. And to me, that will be more of a fundamental related move. And at the same time, the euro pound can go and break support. Does that make some convoluted sense? So it's kind of taking where one is on the technical side, on the fundamental side, and then throwing it all together in the soup. I know I've probably just rambled on there. All right. Now, let's talk about the Fed here for a minute, and we do have FOMC in a few hours. Non-farm payroll made 240,000 jobs. Okay. However, the number of participants in the labor market has gone up to a record high of 90 million, 95.6 million, I believe it is. Okay, so yes, we made 250,000 jobs. Now, bear in mind that here in the United States, you've got to make 124,000 jobs a month to maintain break-even employment. All right, for childbirth, immigration, etc. All right, now, it's reported that 380,000 people last month lost their unemployment benefits. So unemployment claims did not go up, but people lost unemployment benefits. Well, the way we calculate unemployment in the States is if you're seeking benefits, then you're considered unemployed. But if you're not seeking benefits, then you're not considered unemployed. So in other words, 360,000 people, 380,000 people just simply have no money now. 240,000 jobs were made, and unemployment dropped. So politically, it looks great. But we know economically, it's not so hot. All right? So that's issue number one for the Fed to think about. Number two, I don't think they have a quantitative easing exit strategy. All right? They've been helped because I think the Bank of Japan has been sort of picking up the QE bandwagon for them while they've been withdrawing a little bit. But I don't think that they necessarily have the withdrawal program. Okay, so as a result, I'm not looking for the stock market to crash. But I do think it will cost the dollar in the long run. Okay, remember our sort of way of looking at this, and stick with me here for a minute. The drivers of Forex in the market is yield and the anticipation of yield. Okay, so let's look at the US here. We'll talk specifically about the Fed, Bank of England. The Bank of Japan's different. You know, I don't like to. Let's just talk about these two European friends and the US. Australia, Bank of Japan, a little bit different, right? Reserve Bank of New Zealand, Reserve Bank Australia. Sure, yeah, happy to. And it all ties in, so I'll show you an S&P chart and give you my 2 cents on that. Okay, so in these case here, we have interest rates. And we have QE in different forms. What am I doing here? Okay. Right, now, what drives the Forex here is not necessarily what is going on right now for fundamentals. It's what's prospectively going to be going on. All right. So in case of the US, they are tapering to almost being done with QE. Bank of England still in quantitative easing mode, but it's not like they're not adding stimulus to the market, and the ECB is in the situation where they are adding stimulus, right? Interest rates, there's an anticipation of them for Q3 of 2015. So we'll do this. I'm not sold on that, by the way. I think that's noise. All right. Then the Bank of England, no talk of interest rates going up for the time being. And ECB is cutting rates. So what do we have? And when you think about things fundamentally, I mean, this is really as rudimentary as it gets, isn't it? But ultimately, for the drivers of Forex, this is all you need in terms of logic. Okay? And how do we figure this stuff out? Well, Grandma Yellen told us this is the deal. Right? Mario told us this is the deal. These central banks tell us what they're doing. That's the beauty of it. All you got to do is sit and listen, and you get a bedtime story from Grandma, and she tells you what she's doing. It's pretty cool, right? And then, you know, Mario comes in and they say, hey, we got a question for you. And he answers it. Ish. Right, now, So the prevailing fundamentals here are dollar strongest. So we'll give this dollar, I don't know, a 7 in terms of relative strength. We'll give the pound a 5, and we'll give the euro a 2. Absolutely, Joe. Right, now, euro is retracing now. This is more a product of, is this, the euro in retracement mode, is that a fundamental thing? No. It's just time to retrace. So the technicals are telling us, I don't have a dollar index chart on this particular computer, but my other one, it's, the dollar index is due for retracement. And then at about 84.70, it's going to try, 84.5, it's going to try to bottom out again. It's printing 85.60 right now, which is telling us euro to sort of 28.5. Yeah, it's an element of profit taking or loss taking. It's also a case of everything's out in the open now, right? The QE program has been outlined. Mario's come out and told us how bearish he is. All the dirty laundry, barring a banking collapse, is out in the open, isn't it? So now we know Tiger Woods has had 15 girlfriends. Now we can deal with it. And as a result, there's sort of no additional bad news to be priced in at this point. So it's acceptable for it to be in a sort of retracement mode because there's nothing new for people to price in necessarily. Now, does that mean that it's bottomed? I don't think so by any stretch of imagination. As far as the dollar index is concerned, I'm looking for sort of 84.5 to 88.40. And that equates to 28.5 to sort of 29 down to 23 on the euro. So to me, there's another leg here that absolutely want to participate in. All right, but now, what happens? So these fundamentals in my mind are good for 6 months. Okay, but now I think that the Europeans left it a little bit late to add stimulus to the economy, but I also think that they have the willingness, Rory is the man now, I also think that they have the willingness to restructure and go through the pain that's necessary to get ahead again. I spoke to a person here in the States a couple of weeks ago, and they said, well, the economy's still slow, etc. And I'm like, yes, because the Americans haven't been willing to go through the pain. And they laughed at me and they're like, oh, but so many people have had their houses foreclosed on them. If you don't pay your home here in the States, just let it go into foreclosure, it has less of a credit impact on you than if you went, say, delinquent on your payments by a month or two and then caught your payments up. You would be more penalized for saving your home than just letting it go to the bank. But the folks here have this mentality of that's pain, right? Well, I think the Europeans are willing to go through a little bit and have done more historically. Where here in the States, we prefer Big Brother to help us out a little bit and make things warm and fuzzy. And now we're sort of getting this artificial stagnation kind of stagflation thing going on. And I think you'll see noise and a little bit of interest rates heading up where the Europeans, to a lesser extent the Bank of England, will recover quicker. The Australians will recover quicker than what we see here in the US. So in other words, you'll get more of a transition quickly here. These guys will sort of do this. If anything, we're sort of in this flat. Now we're going to look to raise interest rates, and then you're going to get this sort of thing. And the Bank of England, you'll get sort of the same. At the moment it's kind of in this, and I think you'll get the same sort of look like that. So in other words, the euro is going to go towards 7.5.4. All right. And to me, this process could take a long time, maybe 12 months. So really, fundamentally, I think we're going to be doing the same thing for the next 6 to 12 months, and then things are going to start to change. All right. So it makes us, so, what are we going to look for a change? Well, Mario is going to come out and say, well, I'm cutting the QE program. We're starting to see credit improve, blah, 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 blah. You'll start to look at your manufacturing. I mean, the German manufacturing numbers this week were terrible. I mean, you want to talk about the toilet flush of the year. Went kind of under the radar because there's FOMC this week, and it was non-farm payroll last week. But the factory orders on Monday were absolutely brutal. And these are the small little things you're going to look at. I think the euro was fine until it lost Germany. We started to see the French economy tank, the Spanish economy tank, and then, everybody was like, okay, well, as long as we got Germany. And Germany was making noise about splitting, but I think they knew that they were the next. And now you see the German economy slowing down, and that's what really hit the euro. Yeah. And it's the same clues and then everything reverses the same way. So we're going to start to see a German economy improve, and then the French, and then the knock-on effect. And as a result, you're going to sort of see this euro improve quicker, I believe. All right, but for now, the aircraft carrier is heading due south. All right, now, if the US, and this comes back to the S&P question, if the US now figures out that they raise interest rates to 0.5 or 1%, bond yields are rising sort of organically by themselves as they should, and the US economy slows and looks like the Japanese economy, which we expect, I don't think the stock market can plunge. Yeah, Dave, I have friends like that too. It's actually it kind of bothers one a little bit. Sorry, answering a private question. Yeah, I mean, it kind of, you're like, well, hold on a minute. Yeah. There was a lot of folks that were, for the longest time, the trick was to, if you had a house sort of in plot 1, and you were upside down in that mortgage, well, then you would just take out another mortgage on the next door neighbor's house, or, I mean, obviously buy something in your neighborhood, and then let the other house foreclose. I don't know if you're good. No big deal. Just cruise over to the other side. Yeah. Don't even need a moving truck. Just get a couple of dollies and push it across the street. All right. So the point I'm trying to impress upon you here is the time horizon that these things take. Okay? And the fact that you can, guys, when there's an ECB press conference, I know it's boring, right? And Mario, he's so smug that it's very difficult to sit for the half an hour and listen to him, right? But it's well worth your time. And when Grandma Yellen comes on today, it's well worth your time to listen to her, because they do drop little dimes of information. Like today, she's going to keep the language of protracted period in mind. It could mean anything, right? And everybody likes to speculate on it. But until that language changes, this is what we're faced with. All right? So at the moment, we've got small cap stocks unwinding. We have mediums starting to unwind. I'm talking about from 10 billion to 27 billion market caps. And the large cap stuff in the States is holding the strongest, but to the tune of like 13% higher than the small and mid. And that is more of a sort of a flight to safety, bigger dividend deal. But it's only a matter of time until that correlation catches up. Now, if interest rates are going to be low for a protracted period, is it likely the S&P is going to crash? No. So in my mind, you're going to sort of see something like this develop. Okay, here's where we are on this puppy. Okay, we've had this channel going for a long time, haven't we? Long time. All right, now, one touch, two touch, three, I'll call this a touch, 4, 5, and now more today. All right, now, when I show you this on a daily level, what's different here is we tried to get a lower high bounce and it never. It went through the little red zone here, as I call it, of that drop. Here, so the same thing. Here, no bounce at the lower high. Here, no bounce at the lower high. Here, you got a little bounce, quickly followed by higher lows, and it sort of kept this. Here, no. But notice, here we have a lower high bounce. That to me is a technical red flag like difference here. That's saying, okay, newsflash everybody, that is a little speed up of the little downward trend that's been produced. So I think, so now you start to look at, right, where is this fundamentally? Well, fundamentally the Fed's making noise about raising interest rates. Yeah, it's a long way off. But the noise is in the market. Okay? So if we do something like this now, we'll measure it at the top. Measure this. Project that from potentially where a breakpoint is. And you're looking at 18.5. Okay, and if we pop a little fib on here, that's a 382 fib retracement of this last major rise. So, in other words, is it crazy to think that we're going there? Is that a collapse? Not by any stretch of the imagination. Not by any stretch. Okay? And I think what you're going to see is something like this. Additionally, you got a little bit of stochastic divergence here on the weekly chart, which you got earlier on, but now it's accompanied by the fact that it can't sustain above 2,000. So now this is, in my mind, going to cycle down. So you're actually going to be in sort of this bearish formation for some time. So I think you're going to see something like this develop. And it pushes down to this 1850, 1860 zone. And at that point, right back up here again. And then this. And why would, the reason why I think it pushes all the way back up is, one, because we haven't had a cleansing of the rank outright ridiculous bulls. I'm not sure. I don't particularly fancy the shorts right here. Yeah, 1950, 1960, I think is worth starting to short. I got orders in between 65 and 90. Okay, so I think we're going to meander ourselves down, and you're going to get these violent jumps. So you're getting plenty of opportunities. That's the great thing about this. I think it's a more tradable event than a straight cascade to the downside. I expect it to come down to 1910 and then bounce up to 1940 and then drop, more towards 1880 and then bounce all the way back up to 1940 and then go again. I think this bounce 1940 to 1840 is a 100-point bounce. And then at that point, I think we're going to go all the way back to the top. And what could fundamentally happen here? Grandma Yellen comes out and goes, well, hold on, everybody. hold on, we're still seeing weakness across our matrix of numbers, and we are not going to be able to raise interest rates for a protracted period. Rumors of stimulus will kick in. And if we go, yeah, I'm not sure they'll do it, but really it'll be more of a verbal intervention. But interest rates aren't going anywhere. You're looking at Japan, guys. And if we're going to tootle all the way up to the top here, maybe even get to 2040, and then meander around, I think, ready for the better part of a year. Our time horizon on this? I don't know, March. March, April. Up here sometime around August next year. And then range all the way through Christmas. And then maybe 2016 you start to see something just drift back to 1700. But you're talking way off. Like this is 2016, yeah. This will be first part of 2015. And then this will be the second part of 2015. Okay, and this is largely based, in my opinion, on, and that's just one man's opinion, on really what the true job situation is. All right, and yes, you're going to see price inflation drift up, but I don't think you're going to see the growth in wage inflation or employee worker participation in the market. And then wage growth decreasing. So in other words, yes, we produce 240,000 jobs, but wage growth keeps dropping. So it's telling me that the grand majority of these jobs being produced in the United States are not what I'd call career-oriented jobs. They small retail, McDonald's, Wally World, Target, Trader Joe's. The $8 an hour jobs. A lot less, John, but yes. I mean, for the most part, the question I ask myself is, fundamentally, where are we? And I'm like, to me, I still want to be dollar bullish, euro bearish, Aussie on its day, just Aussie, it's sort of what it looks like technically to me and what I'm seeing in the metals. I'm anticipating a little bit of Mexican peso strength based on all the automotive stuff going on down there. So at times I like to short it. If I think it's going to be a dollar weakness day, I like to get long the Mexican peso. And I'm an S&P bear for the time being, but it just depends on support and resistance. So almost every day, I say to myself, can I short the euro today? And until I see the fundamentals change in the euro, it's so weak, I already have no desire to get long the euro. If I'm going to get long the euro, it's going to be maybe euro pound. Maybe. And it fits in quite a lot. Joe. And if it doesn't, I'll just put orders in where I expect them. I'll show you some idea for it. So I'll do every day. I'll do something. Every day I'll do something like this. I'll plan for it. So whether it comes to fruition or not, that's for a different. That's a different story. But so I'm just logging into my little charts here. Slower than pond water, apparently. So here's an example of one where, essentially you get it wrong. So here's a DAX chart, and I'm bearish on the DAX, given what I showed you on the S&Ps. So I thought that we'd come down to 93, push up to about 95.50, and then head down to roughly 90 cents, 99,000 rather. Okay, what actually happened? You can see my little red dot there. So we got to 95 and change, and then just fell through the floor. So is this one where I caught? Sadly, not so much. Okay, but the planning is there every single time. Let me give you. So here is a Euro yen 4-hour chart. Okay, and I have this puppy. This is yesterday. I have this puppy coming down to around sort of 36.70, going up towards 138 to 138.50, and then falling 200 pips. So I've piled orders up through here, and so far it's got another 70 or 80 pips before it starts triggering them. But I'm bearish on this. Yeah, there's probably money to be made on this upside, but I'm also worried about it sort of just slipping, just sort of trickling, doing something like this. So I don't necessarily want to participate in this upside because I'm a bear. So then I just pile orders in here. So, there's a lot of times where I might wait 2 or 3 days and then I have like 6 or 7 things triggered. And then other times I'm sitting around, I'm sitting around hanging out with myself. This is pound dollar. Good times, Dave. S&P's just on the short term, I'm looking for something like this. This is what I had in mind for S&P 500 today. So I'd encourage you, even if sometimes you're not going to get exactly what you'd expect, but the planning of it, and you can see that the trades are based, the positions may go against what I want fundamentally, but I'll wait until the technicals give me what I want to go trading. Okay, so here's today's S&P trade plan. I had us going up here to the early 40s, dropping down to 1910, and then rebounding to 1935. So, it didn't get 46. It had a few things, running from well, but it didn't get to 46, and I didn't feel comfortable shorting it at 30 odd because of this. It's very difficult to gauge, even though I think it's going to break, it's very difficult to gauge if this is going to bounce in any meaningful manner right at the support. So really, if I hadn't found an opportunity to short, through here, what am I doing trying to short there? So if anything, now I've got to let it kind of break this. So hello world, and everybody goes, no, not yet. Come back up here. Okay, great. Let's go. So 1940, 1950 down to 1880. Make sense? So am I trading intraday? Yes. If that works out. If not, I'll sit, I'll read, I'll catch up on other things. Okay. So I feel like we covered a reasonable amount of things today. Thank you for participating. I hope that you learned something. And I apologize for the second. I had a lot going on. It was ECB, and I clean forgot about the webinar. So If you pitched up in a second and I wasn't here, I humbly apologize. And if you want to reach me at Forex David, FOREX DAVID. Okay. Thanks, guys. Enjoyed it. And don't be a stranger. We'll talk to you soon.